Okay, so you want to own student housing. Every August, thousands of 18-year-olds show up with a truck full of stuff and a parent holding a checkbook. On paper, this looks like the easiest lease in real estate. A captive audience that has to live somewhere, and parents who will pay almost anything to keep their kid close to campus. No recession stops enrollment. Kids keep signing up for college even when the economy tanks. So it sounds like a machine that prints money every single fall, no matter what happens to the rest of the housing market. Here's the part nobody tells you. Student housing might be one of the most exhausting property types you can own. A normal apartment building might turn over 40 to 50% of its tenants in a given year. Student housing turns over basically all of it. Every single bed, every single year. That means you're not just re-renting a few empty units. You're re-leasing the entire building from zero, every 12 months, forever. And you don't get all year to do it either. Most of that leasing has to happen in a window of about 6 weeks, sometime between October and December, for beds that won't even open until the following August. Miss that window and you're stuck waiting a full year for another shot. Then there's who's actually living there. 19-year-olds, many away from home for the first time, running space heaters and mini fridges off outlets that were never built for it. Breakers trip, walls get punched. Carpet gets ruined in ways a 40-year-old renter just doesn't manage to pull off. So here's the paradox. The exact thing that makes this asset class bulletproof against recessions is the same thing that makes it brutal to run. Kids keep enrolling no matter what the economy does, so the demand never really disappears. But because every lease resets every year, you get zero cruise control. You're always selling the building again. By the end of this video, you'll know what it actually costs to build or buy one of these properties. Real numbers, not guesses. You'll understand why operators charge by the bed instead of by the apartment, and why that one pricing trick changes the whole business. You'll hear about American Campus Communities, once the biggest student housing company in the country, bought out by Blackstone in 2022 for $12.8 billion. And you'll see how a much smaller operator got completely wiped out because of a single bad leasing season near one mid-size university. Because in this business, you're not really renting apartments. You're reselling the same beds over and over to teenagers whose parents are legally stuck with the bill. So what does it actually cost to get into this? There are really two ways in, and they don't look anything alike. So let's start with the expensive one. If you're building purpose-built student housing from scratch, you're looking at roughly $60,000 to $120,000 per bed, not per unit, per bed. That number moves based on the market and how nice you're making the place. A bare-bones building with basic rooms lands near the low end. Add a pool, a gym, a study lounge, and a parking garage, and you climb fast. Now go to a flagship football school and the number stops being a range and starts being a warning. Near the University of Texas in Austin or Alabama in Tuscaloosa, developers are paying somewhere between $180,000 and $300,000 per bed. That's the land premium. Everyone wants to build next to a school with 50,000 students and a packed stadium, so the dirt itself gets pricey. Put real numbers on a real building. A typical 400-bed property costs somewhere between $30 and $50 million to build, start to finish. That's not a loan you get with a good credit score and a handshake. That's a construction loan, an equity partner, and a very long spreadsheet. Now, you don't have to build. You can buy something that's already up and running and that works completely differently. Existing student housing sells based on something called a cap rate, which just means how much yearly profit you're buying relative to the price. Today, that's running about 5.5% to 7% in most markets. Say a property is already clearing $2 million a year in net income after covering its own operating costs. At a 6% cap rate, that building trades for somewhere around $33 million. Push the rate to 7, and the price drops closer to $28 million. Push it down to 5.5, and the same building is worth over $36 million. Small rate moves swing millions in price. That's the institutional tier. Big buildings, big loans, big names. But there's a completely different door into this business. Instead of building a 400-bed tower, you buy a handful of regular houses near a regional university and rent them out by the room. These houses run about $150,000 to $400,000 each, depending on the town and how close you are to campus. A landlord with 4 bedrooms rents out each bedroom separately to a different student, the same way the big REITs do it, just at a tiny scale. This is the mom-and-pop version of the exact same business model. No construction loan, no institutional equity, just a mortgage and a truck. One side of this business is Blackstone writing a $12.8 billion check. The other side is a landlord who owns 4 duplexes and a lawnmower. Both of them make money the exact same way, by charging per bed instead of per unit. So how does that actually turn into cash? Okay, so how does a building full of teenagers actually make you money? Here's the trick. A normal apartment building rents out a 2-bedroom unit for one price to one household and gets one check. Student housing throws that out. You take that same 4-bedroom, 4-bathroom unit and rent out each bedroom separately, with its own lease. So instead of one rent check for the whole unit, you get 4 checks, one from each roommate, each paying their own rate for their own room. Do that math across a whole building, and you're often pulling in 20 to 30% more revenue per square foot than a regular apartment complex gets. That's the entire secret. You're not renting square footage, you're renting beds. 4 kids, 4 leases, 4 separate sources of rent. But here's the part that makes this work even with tenants who've never paid a bill in their life. Almost every lease requires a parent cosigner. If little Ryan skips rent to buy concert tickets, the property doesn't just chase Ryan. It goes after his parents, who are legally on the hook. A lot of these leases are also joint and several, meaning all 4 roommates are equally responsible for the whole unit's rent, not just their own room. So if one roommate bails halfway through the year, the other 3, or their parents, can be on the hook for covering that empty room. That's why student housing has historically had lower bad debt than regular workforce apartments, even though most of these tenants have 0 credit history. You're not really underwriting an 18-year-old. You're underwriting their parents' checking account, and that changes the entire risk profile of the building. Now here's where the calendar gets weird. Leases usually run 9 to 12 months, built around the school year, not a random move-in date. And pre-leasing for next August actually starts the previous October, sometimes even earlier at the biggest schools near football powerhouses. So the leasing office spends October through March signing up next year's tenants, months before this year's tenants have even finished exams. The industry benchmark is brutal. You want 95% of beds leased before move-in day, or the whole year's numbers are already in trouble. There's no slow trickle of new tenants throughout the year like a normal apartment complex. It's one sales season, and then you live with the result. On top of base rent, there's a second layer of money that adds up fast. Parking passes running $50 to $150 a month per car. Then you stack on pet fees, storage rentals for the summer when kids go home, and application or amenity fees charged just to move in. More properties now bundle Wi-Fi and utilities right into the rent, which sounds like a convenience but actually pads effective rent per bed by another 5 to 8%. It's the same trick airlines use with baggage fees. The advertised rent is just the starting number, not the real number. And here's the tailwind behind all of it. Rent growth at purpose-built student housing has been outpacing regular apartment rent growth in recent years. Why? Because it's genuinely hard to build new housing right next to a top-tier campus, so supply stays tight while enrollment at big schools keeps climbing. So you've got parent-backed payments, 4 rent checks per unit instead of 1, and fees stacked on top. Sounds close to bulletproof, right? Except this whole machine runs on one brutal assumption, that every single bed gets re-rented, from scratch, in the same 6-week window, every year without fail. So what's the stuff nobody warns you about? Here's the number that trips up new operators. Conventional apartments turn over maybe 40 to 50% of units a year. Student housing turns over 90 to 100% of beds, every single year, like clockwork. That means you're not touching up a few units a year. You're repainting, replacing carpet, and fixing appliances in almost the entire building every single summer. Industry numbers put that at $500 to $1,500 per bed, every single turn. On a 400-bed property, that's $200,000 to $600,000 a year just to reset the beds you already own. Compare that to a normal apartment complex, where you might only fully turn a third of your units in a given year. Then there's the tenants themselves. Most of these kids have never lived on their own before. They don't know you're not supposed to run a space heater and a mini fridge off the same outlet. Walls get holes in them, blinds get broken, somebody definitely microwaves something they shouldn't. So maintenance reserves in student housing run higher than standard multifamily, because the wear and tear is just built into who's living there. Insurance is another line item that catches new buyers off guard. Student housing carries more liability risk than a normal apartment complex, mostly because of parties and alcohol. One bad incident at a rager on the 4th floor can turn into a lawsuit, and insurers price that risk in before it ever happens. So premiums for student housing typically run meaningfully higher than a comparable conventional apartment building. Now think about staffing. Remember that 6-week leasing window from the last section? Your leasing team has to hit occupancy targets in that tiny window, or the whole year is already broken. That means more leasing staff per bed than a normal property, plus more marketing spend, because you're basically running a sales sprint every fall. If a property doesn't bundle or sub-meter utilities, that's another cost that quietly eats the margin, especially with kids who leave the AC running with the window open. Buy an existing property, and the county often reassesses it at the new sale price. Your property tax bill can jump right after closing, sometimes by tens of thousands of dollars a year. And here's the one that can wreck the whole model overnight. Your entire business depends on one number: how many kids that university enrolls. If enrollment drops, or the school builds its own new dorm next door, your occupancy assumption just breaks. And there's no slow fix for that. So who's actually built something real on top of all this, and who's gotten crushed by it? Start with the winner, because it's a big one. Bill Bayless started American Campus Communities in the 1990s with a simple bet: college kids need beds, and nobody was building for them properly. He took the company public in 2004, and over the next 2 decades it grew into the largest owner, developer, and manager of student housing in the entire country. In 2022, Blackstone bought the whole thing for $12.8 billion, about $65.47 a share. That's one of the biggest student housing deals in history, and it's not a fluke. Blackstone doesn't write a check that size on a hunch. They looked at decades of occupancy data, rent growth, and margins, and decided this business throws off real, durable cash. That deal alone should tell you the model works at scale. American Campus Communities isn't alone at the top either. Landmark Properties and Core Spaces are 2 of the biggest developers building what the industry calls resort-style student housing. Think rooftop pools, private study pods, tanning beds, and package rooms the size of a small warehouse, all built next to flagship schools like Alabama, Texas, and Georgia. These companies aren't guessing where to build. They're chasing schools with rising enrollment and not enough dorm space, which is exactly the setup that makes 95% occupancy realistic. Now here's the flip side, because for every winner like that, there's a much smaller story that plays out over and over in this business. Picture a private operator, maybe a small syndication that raised money from a handful of investors, who builds or buys a property near a mid-size regional university, not a football powerhouse with guaranteed demand, a smaller school where enrollment can swing up or down depending on the year. They underwrite the deal assuming 95% occupancy, because that's the industry benchmark, and they size their construction loan around that number. Then a competing property opens across the street the same year they're trying to lease up. Suddenly they're not filling 95% of their beds. They're filling maybe 70 to 75%. Because the market only had enough students to fill 1 new building, not 2. Remember, this isn't like a regular apartment building where a bad year means a slow bleed. The whole revenue base resets every August. Miss 1 leasing season and you don't lose a little income, you lose a quarter of your expected cash overnight. That gap is often enough to trigger default on the construction or bridge loan, because the lender sized that debt assuming the building would be almost full. This isn't some rare horror story. It's a well-documented pattern across smaller student housing deals, especially from 2023 into 2024. A lot of these construction loans were floating rate, meaning the interest payment moves with market rates, and they came due right as rates spiked. Operators who needed to refinance suddenly faced monthly payments far higher than what they'd underwritten, on top of occupancy that already came in soft. So you've got a business where the biggest player in the country just sold for $12.8 billion, and smaller operators just 3 hours down the highway are getting wiped out by one bad fall. So how do people actually lose their shirt on this? It's always the same setup. A developer builds a brand new property right next to a mid-size university, betting the school keeps growing every year. They finance it with a floating rate construction loan, meaning the interest rate isn't locked in. It moves with the market, usually short-term debt meant to get paid off fast once the building leases up. The whole plan only works if the building hits 95% occupancy in year 1, because that's the number the loan was sized against. Then something goes wrong. Maybe a competitor opens a shinier building across the street that same fall. Maybe the university's enrollment comes in flat instead of growing. Maybe interest rates just spike right when the construction loan comes due and needs to be refinanced. In a normal apartment building, that kind of bad luck is a slow bleed. Tenants trickle out over a year or 2, and you have time to adjust. Student housing doesn't work that way, because the entire building resets every single August. There's no slow bleed here. There's a cliff. Miss 1 pre-leasing season, the 6-week window every fall when next year's tenants sign, and you don't slide down to 90% occupancy. You fall straight to 70 or 80%, while your loan payments are still sized for 95. That gap is brutal. On a $40 million property, Even a 15-point occupancy miss can mean hundreds of thousands of dollars in rent that was underwritten and just never shows up. This is exactly what played out across the industry in 2023 and 2024. A wave of smaller purpose-built student housing deals had been financed with floating-rate construction loans back when interest rates were near zero. Those loans came due right as rates had climbed several points higher, so refinancing meant swapping cheap debt for expensive debt, sometimes doubling the monthly payment. Thinly capitalized operators, meaning ones who didn't have much cash cushion beyond the loan itself, got squeezed from both sides at once. Soft leasing on one end, brutal refinancing terms on the other. Plenty of them didn't survive it. So the whole model comes down to this. Build for guaranteed demand, but get hit with even a single bad season, and there's no cushion to fall back on. Which raises the obvious question. If one bad fall can wipe you out, how do the operators who survive actually protect themselves? And how do the smart operators build a cushion against all that? Some of the biggest names in the game don't even own most of the buildings they run. Landmark Properties and Core Spaces develop student housing, but they also manage buildings owned by outside investors, collecting a flat management fee off the top. That fee usually runs 3 to 5% of gross revenue, and it shows up whether occupancy hits 95% or falls short. No construction loan, no leasing risk, just a steady check for running someone else's property well. Some universities have taken this a step further, signing master lease deals directly with private developers. The school agrees to fill a set number of beds every year, so the developer gets guaranteed occupancy backed by the university itself. The trade-off is lower upside. You're not chasing market rents, you're locked into a set arrangement, but you also can't get wiped out by one bad August. Then there's the dead months. Student housing sits mostly empty from May through August, which sounds like lost income, but a lot of operators fill it anyway. Sports camps, academic conferences, and summer session students all need short-term beds, and a building sitting idle can rent those rooms by the week instead of the year. It's not huge money, but it can add several $100s per bed across a slow season that would otherwise generate zero. Other operators go the opposite direction and buy old, tired off-campus houses near a school, then renovate and reposition them at higher rents. A $200,000 house that gets new flooring, updated bathrooms, and central air can often jump from $450 a bed to $650 a bed almost overnight. That's the same math flippers use on regular homes, just applied to a rental that resets its lease every single year. The scale you operate at changes which of these actually makes sense for you. A landlord with 4 houses near a regional school can self-manage, know every tenant by name, and ride out one bad semester on savings. A company managing thousands of beds across a dozen college towns can lose an entire building's occupancy and barely feel it because the other 11 campuses cover the gap. So what does the money actually look like once you're in the deal? Let's start small. You buy 4 off-campus houses near a regional university, $250,000 each, $1 million total. Each house has 4 bedrooms, and you rent by the room, not by the house, at $500 a bed. That's $2,000 a month per house, or $8,000 a month across all 4, which comes out to $96,000 a year in gross rent. Now subtract the real costs. Maintenance, property taxes, insurance, a bit of vacancy, maybe a property manager, that eats about 40% of the gross. You're left with roughly $57,600 a year in net income before the mortgage even gets paid. Put 25% down, that's $250,000 out of pocket, and finance the rest, and your actual cash-on-cash return lands somewhere around $20,000 to $30,000 a year. That means it takes about 8 to 12 years just to earn back your original down payment, before you've made $1 of profit. It's a real business, but it's slow, and it's you personally fixing a broken water heater at midnight in year 3. Now scale it up to the other end of the market. A 400-bed purpose-built property, $40 million to develop from the ground up. Once it's fully leased and stabilized, that building throws off about $2.4 million a year in net operating income, roughly a 6% return on what it cost to build. Here's the part institutional developers actually chase. Sell or refinance that same building at a 5.5% cap rate, and it's now worth about $43.6 million. You spent $40 million to build something worth $43.6 million the moment it's full. And that gap is the real profit, not just the rent checks. After that, the building still throws off $1 to $1.5 million a year in cash after the debt is paid, year after year, as long as beds stay full. Do that enough times across enough campuses and you end up looking like American campus communities. The company Blackstone bought for $12.8 billion in 2022. That's the ceiling. Thousands of individual bedrooms, each one re-rented every single August, stacked into a $12.8 billion sale price. So no, you were never really in the housing business. You were in the business of selling the same bed 100 different times to teenagers whose parents are legally on the hook for the check.